Larry, let's start with you, where the Fed was the big news, I guess, of this week. They came out with their decision. It sounded pretty much like what they said they were going to do back in August with their new strategic strategy, and yet the markets didn't like it at all. What went wrong? It felt like a little bit of a temper tantrum.
Markets liked it for a while, then the markets didn't like it. Look, I don't think this is that complicated. The Fed's got its foot on the accelerator to the floor. The car's not going that fast. The Fed says it's going to keep its foot on the accelerator to the floor, but it also says that it's going to be looking around in case there are any accidents and be willing to change that. So people don't feel that great about the situation when things are going slowly with the accelerator to the floor. And that's kind of the reality that we're dealing with. I don't think it's within the gift of the Fed to cause our nation to be competent in testing people to control COVID. It's not within the gift of the Fed for people to find it in their hearts to respect their fellow citizens, regardless of race. And it's not within the capacity of the Fed to provide the fiscal stimulus that the economy needs. So the Fed's doing the best it can, but unfortunately we live in a world where if it was ever true, it's not right now that the chairman of the Fed is the second most important person in Washington.
So Dan, you served in the Federal Reserve. Do they have, to continue Larry's analogy, an effective speedometer? That is to say, insofar as they're saying, let's get the inflation rate up, we're willing to tolerate more than 2%, is there a speedometer that really tells them where inflation's going? Do they have a theory?
Well, no, there hasn't been a working theory of inflation for central banks for quite some time now. I mean, the flattening of Phillips curve, which occurred obviously some years ago, but the central banks have finally caught up to seeing that it is flat, means that there's really no way to be particularly predictive. And I think that's one of the reasons why the Fed was unanimous in shifting to an approach to monetary policy that looks more at actual inflation rather than predicted inflation based on expectations of where the unemployment rate is going to be going. You know, David, on the question you asked Larry a moment ago, I do think that there's a bunch of intra-market stuff going on here. I mean, if you look at what some of the market commentary said, the disappointment came because Chair Powell didn't go forward with giving some more indication of where quantitative easing would be. That sounded to me like a situation in which there were some financial actors who had certain positions which would have benefited from a little more specificity on QE than they got, but not very much to do with the real economy.
So, Larry, one of the things that I'm intrigued in is the extent to which basically the stock values have been driven by the discount factor. When you get down to zero or close to zero, theoretically, the value of stock could be infinite. Is that part of what's going on with tech, that people are figuring out that part of the value that's put into the stock of tech is actually because the interest rate's so low?
Yeah, I don't think there's any question that the longer lived a financial asset is, the more sensitive it is to interest rates. And if you're a growth company, you're a longer lived asset in terms of your future profits and your future cash flows than if you're a value company. And that explains a lot about the cleavages that we've seen in the stock market, along, of course, with the fact that various kinds of IT companies have seen their underlying businesses strengthen because people can't go to stores and can't go outside. So I think that's what's going on. But look, as Bob Rubin used to say during the Clinton administration, markets go up, markets go down, and there are going to be fluctuations and they're not going to be obvious causes for them. So I think it would be a mistake to be over-interpreting movements of a few percent over a few days. I think the deep truth about our moment is that the Fed doesn't have the capacity to predict inflation with great accuracy and doesn't have the capacity to control inflation with any great efficacy, given that it can't move interest rates down, and there's not much reason to want to move interest rates up. And so without the ability to predict or control inflation, the Fed becomes a bit more of a sideshow. And for people who have relied on the Fed to make their life work and to achieve what they want, that's a discouraging and perhaps even somewhat disillusioning thing. It doesn't mean that the Fed isn't doing the right thing. There's some underlying realities here that shape the situation.
So Dan, thus far the markets have been fairly reassured by the Fed essentially giving an underpinning to the markets. Is there a risk here, a macroprudential risk, basically in having almost free money indefinitely?
Well, presumably over time there will be, which obviously counsels renewed attention to financial regulatory policy. Your viewers may have noticed that in the Fed's statement of longer-term strategy, there was a paragraph about potential financial stability concerns. How that translates into Fed action, I think they've left substantially less clear. I mean, they're lean against using monetary policy itself as a way of restraining inflated assets, but they haven't made clear what, if anything, they're prepared to do with regulatory policy, which, by the way, probably isn't adequate to deal with the leverage and short-term financing that hedge funds and REITs and lots of other intermediaries can engage in. David, I just wanted to add something, or maybe put things in a slightly different way than Larry did a minute ago about the role of the Fed. I'm not sure I'd characterize it as a sideshow quite, because for a couple of reasons. One, as a liquidity provider and as a regulator, it's still quite important. And I also agree with what Larry was saying about the diminished capacity of the Fed to rectify the macroeconomic issues and problems that we've got. But I actually would say, that I think where the Fed is almost inevitably headed is towards more of a de facto partnership with the Treasury Department, with the executive branch. That is, because of the dependence on fiscal policy to move us out of the situation we're going to be in for quite some time, because of the Fed's commitment to keeping rates low and thus keeping rates at the long end, presumably at the long end of the yield curve low, as well as at the short end. I think you're going to see almost inevitably an increasing amount of purchases of treasuries over time. And you're going to see the need for the Fed to think more closely about how it fits in with fiscal developments, debt issuance. Right. And under those circumstances, as I've described them, do not sound like the independent Fed that we've gotten used to since the early 50s, when Treasury and the Fed agreed to break apart the cooperative arrangement they had had during the war.
Yeah, and Larry, listen, maybe a truly independent Fed is not what we need right now, but whether it's dependent or independent, this de facto partnership isn't going to get us where we need to go with the economy overall. I mean, long before the COVID-19 hit, you were talking about secular stagnation. We had very modest growth. We did not have productivity growth. What do we need to get productivity growth going again and real fundamental growth going in the economy?
Dan and I are basically in agreement. You know, some of this has been in the making for a long time. If you thought about the early financial crisis years, every month or every 2 months, the Fed was proudly announcing that it was going to do quantitative easing, where it was going to issue short-term debt and buy long-term debt in order to stimulate the economy. And the Treasury Department every month was announcing that it was going to issue more long-term debt to lock in low rates for the benefit of taxpayers. And basically they were trading with each other and making the broker dealers rich. So the idea that we're going to have more coordination, I think, is overdue and welcome. And at a moment when we've got inflation below what we want, I'm not deeply worried about some sacred independence of the Fed at all. I also agree with Dan that perhaps I should have said conventional monetary policy is a sideshow, because there certainly are important regulatory decisions. And if we have another panic, the Fed will certainly have a crucial role in dealing with that panic. I think with respect to regulation, David, the problem always is that we realize we should have regulated when we're in a mess and we need more credit, not less credit. And regulation will slow the flow of credit. But I think the idea that Dodd-Frank had solved all the problems was never a very plausible idea. And I think that it was to Dan's great credit during his time at the Fed, that he was always pushing to do more on regulation rather than, as many others were, to be complacent about what had been put in place. Look, David, to get the economy growing, we need to get COVID in the rearview mirror, which means we need extensive testing with fast reporting and action based on the results. Until we have that, or we have a vaccine, and I don't think a vaccine's going to come that fast, we're not going to have a rapidly growing economy. Once we have that, in order to really have a rapidly growing economy, we need much more public investment in virtually everything that we've had, whether it's infrastructure. Look, when I started flying from Boston to Washington, it took an hour and a quarter. Now it takes an hour and 45 minutes. That's not because jet engine technology has deteriorated, and it's not because Washington or Boston have moved. It's because of a deteriorating infrastructure in our country. And that's a small example of what's going on in everything from transportation to the quality of the laboratories in our schools to the way in which we produce electricity. We need investment in innovation and education, and the right program of coherent investment in America's future doesn't bust the deficit. It sets the stage for future prosperity and a lower debt to GDP ratio.